talk about blockbusters, and this is one. We do have a very interesting day ahead, and let me start with a quick introduction. My name is Ram. I'm a senior partner with Cedar. What we have today is a day fully packed with some very interesting, extremely engaging, thought-provoking, enlightening discussions. We have amongst us through the day with some discussions, panelists who come from various banks, leaders from various organizations, and some very interesting discussions today on talk about digital transformation in Oman's landscape. We're talking about fostering fintech innovation. We'll also talk about what does it take to actually be chartering the future of wholesale and retail payments. And of course, there is also going to be a discussion on adding the power to digital Islamic banking. These are the various topics of discussion for today. I know there is a lot of excitement about the discussion because this is the second edition of our summit here in Muscat. And thank you for your overwhelming endorsement of this platform and patronizing us. What I would do is, obviously the discussion today is actually more on digital and what we actually are having. The summit is obviously on NextGen banking and technology. But we would actually be starting the discussion with the banking component of what that NextGen banking is. So I have a small, quick overview presentation, should I say, from a keynote standpoint. And then we'll go into the technology part. But this is more from a banking trends globally, right? Now, as many of you know, Cedar has been operating in the Middle East since '99. We are a US-based firm. We've been operating in the region since '99, working with all the leading banks. Almost all of you here are friends, should I say, with whom we've worked over the years. IBS Intelligence, as many of you are already aware, is the fintech research arm, the unit of Cedar. It's a UK-based entity. You could actually pretty much consider it to be the encyclopedia or the go-to platform when it comes to research on any supplier, any transaction, anything that's happening in the fintech space, be it innovation or be it engagement of which bank has been doing around the world. Besides, of course, there's a lot of advisory piece. So this is a platform from both Cedar and IBSi. And this first part of the discussion today would actually be on what's happening from a global banking standpoint. We'll talk about what's happening globally, and then we'll talk about GCC and then about Oman. I mean, there's some interesting stuff out there for your consumption. The first piece, as you can see there, is if you take the top 100 global banks, they collectively contribute to 112 trillion of total assets. And if you consider looking at their return on equity, it's about 12.5%. And what's interesting is the cost-to-income ratio of global banks operates in the range of 50 to 55, 52 to be precise in this case, right? Some interesting numbers there for us to bear in mind. But what you also see is what's happened over the last few years is thanks to digital, you find that operating efficiency and the cost-to-income taking a very important impact globally, and we'll talk about the region in a minute. So of course, these are topics we'll be talking later today, but if I was to pick the top 5 or 6 trends that we have seen globally, you would talk about AI and machine learning, digitization and automation, which has significantly contributed a lot to the improvement in operating efficiency. Open banking, I think that's another topic we'll talk a lot today. Embedded finance, ecosystem banking, and of course, the rise of neobanks. What we did was we picked the top 5 or 6 banks globally by their market cap and asset size. And we said, what do you see as the trends that you observe amongst these banks, right? It gives you a perspective. And what you see is that you will find that global banks are operating at an LDR, which is, as you can see there, in the ratio of anywhere between 50 to 70. Capital adequacy is operating at about 15 to 20 or 18 in that range. And more importantly, you also find that loans and advances have been growing, excepting a couple of banks. There has been a growth over the last year. And if I also look at the operating metrics, you find that the ROE operates anywhere between 10 to 18. You also see that their there is a trend that you see on asset per employee operating in a certain range, excepting the Indian bank. Most banks operate in the range of 12 to 15, right? That's clearly what you see as asset per employee. These are interesting anecdotes because that also sets the tone for what you see in the region. So let's get into the region. From a GCC standpoint, what you see is we have about 3 trillion in total banking assets. Islamic assets contributes to 1/3 of it. You do find that the asset growth has been in the range of 10% year on year, which is also reflecting the growth that we're observing in the region. And again, if you pick the top 4 or 5 banks in the region, and these are reflective of the respective regional countries as well, I think amongst the important aspects you see there is you find that the NPL ratios are operating higher than the global average. That tells you about the risk profile broadly in the region. And you also find that fee income as a percentage of total income, the net fee income is operating within the global fee income range, right? And of course, ultimately it's all about ROA, and you do see that ROA in the region is operating higher, so higher risk and higher return, right? Which is reflective of what you see in the region. Now, let's jump into Oman and look at what we have in the Oman banking landscape. We have a total banking assets about 19 billion USD. We do find that our banking growth has roughly been about 5%. This is about HY 2023. We do see that our Islamic banking growth has been faster than that of the overall banking, which also reflects we also have a topic of discussion today, and that's also reflecting what the trend in the industry is. The important aspect is about payments, and we do have a topic today on payments. You find that what you see is the penetration levels of debit and credit card is expected to also be increasing collectively. This is debit and credit, mind you. Now, keeping the global context and the Omani context, you do see that the capital adequacy globally operates at 15 to 20, GCC at about 16 to 22, and we operate around the same range. And you also look at our LDRs, loan deposit ratio, to be higher than what you see in the region, which also gives you a perspective on how the banking sector is working very closely with the government in terms of driving a lot of economy, and therefore the LDR numbers are slightly higher than you see in the region. Our return ratios, however, are much lower. So you find that our ROEs are relatively lower than our peer GCC banks. Our cost to income ratio is much higher, which reflects why the returns are lower. So clearly our costs in Oman are a shade higher than what you see in the region and of course globally. And if I was to summarize what you see here and what does it mean from a key takeaways for us as an industry, and I must thank my colleague Nitin, who actually helped me in having some of these perspectives articulated here. Clearly we see that our NPL is, we are operating at a range slightly higher than the region. So clearly we do have a focus that needs to be in there. Our cost to income ratios clearly is a shade higher, in fact, a couple of shades higher than what you see in the region, which is again reflective of the topics we spoke about and will be speaking about today, which is automation, operating efficiency, and how do you drive costs down. On the revenue front, one area that many of you are aware that we've been championing as a cause here is how do you, as a bank, ensure that you're operating at the right fee income numbers. You find that our numbers, there is scope and potential for us to be improving there, and that's clearly reflected in the numbers you see there. Obviously, if you drive your costs down and if you improve your NPL numbers down and improve your fee income, then your ROAs are likely to improve. And that's a derivative, not a driver. And as a function of that, we also find that our asset per employee numbers can improve. You may have limited control on the denominator, but you do have a control on the numerator, which is looking at driving your assets, and that's how that could actually be impacted. That's just setting the tone for the discussion today, and I unfortunately don't have time for a Q&A on this because we do have a whole day packed with discussions, but I would be more than happy to chat with you at the next break, and we do have some very interesting panels. Please enjoy the discussions today. I hope this is actually thought-provoking, worth your while being here, and thank you once again for being here. Good day.